Today I'll explain why more Americans are claiming Social Security benefits early and whether that choice is smart or potentially costing you hundreds of thousands of dollars. Recent reporting from AARP shows a 16% spike in early Social Security claims this year, and nearly half of those who filed early or considered it say they did so because media headlines claim the program is running out of money. Even higher income individuals, those with the most flexibility to delay, are now starting benefits at age 62, accepting as much as a 30% permanent reduction compared to waiting until full retirement age. And this shift is not just about demographics. Researchers at the Urban Institute say population growth alone simply does not explain the spike. What we're seeing instead is behavioral, fear, panic, and reacting to headlines. And here's the key. Your claiming age is an irrevocable selection. Once you start, you cannot undo the benefit cut. So when decisions are driven by panic, they often override clear financial logic. And that's exactly what I want to talk about today. Is this panic justified, or is it an emotionally fueled decision that ignores logic? Before we dive in, this video is for informational and educational purposes only. We are going to walk through examples and illustrations, and they are hypothetical and not guarantees of future results. Okay, first, here's what you should know about the state of Social Security. Social Security is primarily funded through ongoing payroll tax revenue. True, the trust fund reserves are projected to run short by 2035, but even then, current models suggest benefits could still be paid at 83% of scheduled levels in 2035, when the trust fund is expected to be depleted, and this figure could decline to 73% of scheduled benefits by 2098. So the idea that benefits will completely vanish is unfounded. What is real is this: early claiming comes with permanent costs. And when you're reacting to fear, you often trade certainty of income now for a much smaller lifetime benefit later. And that brings us to the real question: should you delay? And if so, what's it actually worth? Let's talk about what leading researcher Michael Kitchis calls the real investment return of delaying Social Security. You've probably heard that delaying past your full retirement age gives you an 8% bump per year until age 70. That's true, but it's an oversimplification. What a lot of these analyses leave out is opportunity cost. The benefits not paid from age 72 to 70 represent a foregone investment opportunity, meaning the money could have been invested if it wasn't needed, or it could have been consumed and thereby allowed other assets to remain invested. It's not just about getting more money later, it's about making up the foregone benefits from delaying. Imagine your benefit at full retirement age is $3,000 a month. If you start at 62, you begin collecting earlier, but at a permanently reduced rate. In this case, claiming at age 62 results in a 30% reduction, or $2,100 a month. But if you were to delay to full retirement age, that's age 67 for most people considering this decision right now, that is a full 5 years from 62 to 67 of foregone benefits. Your portfolio must cover that gap if you delay, and that cost is often ignored in simple calculators. Walking through the Kitchis article titled "How Delaying Social Security Can Trump Long-Term Portfolio Returns or Lifetime Annuity," it's a breathy one. The first chart he shares is on the Social Security delay break even. And this chart shows what happens if you delay from age 62 to 70, assuming a 3% inflation and 6% growth on your portfolio, and the cost of waiting for the higher benefit. In this example, the individual is looking at a monthly benefit of $750 at age 62 versus a monthly benefit of $1,320 at age 70. At first, you are underwater. That's the income you've given up by waiting. But look what happens around year 22, or roughly age 84. You break even. And after the break-even point, the line takes off sharply upward. The longer you live, the more delaying pays off. That's the key here. The decision to delay grows exponentially every year as compounding time value of money now works in favor of the delay decision. But yes, 22 years is a long time to merely break even, because the cost of not receiving benefits for 8 years takes a long time to recover from. The decision to delay is not just about when to begin benefits, but a choice between taking the benefits versus spending from the portfolio and waiting for the higher benefit. So the decision to delay must be discounted by opportunity costs of not being invested in the portfolio. Now, here's the second chart. This is the internal rate of return on that delay. And this is another way to look at the decision. This is the break-even rate of return that would have been necessary at various points along the time horizon to have achieved a comparable result. Of course, it starts out ugly, deeply negative, showing that the decision to delay is risky if you pass away early. Once benefits begin at year 8, it takes another 8 years for the excess payments to make up for the years benefits weren't received. At the 16-year mark, the internal rate of return hits 0%, and then it takes another 6 years until the internal rate of return equals a 6% growth rate. That's the 22-year break-even point we just saw at age 84. But just like we saw in the last chart, beyond that point, the internal rate of return continues to increase. Now, in this third chart, Kit just translates the nominal internal rate of return to the real internal rate of return, which is the inflation-adjusted returns. Kit just points out that those who reach age 90 have generated a 5% real rate of return in what is essentially a government-backed bond. And these are his exact words. By contrast, the long-term real return on equities has been only about 7%, which represents a 7% equity risk premium over an alternative risk-free rate, which means for equities to generate a comparable risk premium over the value of delaying Social Security, equity real returns would need to be 8.3% after 20 years, 11% after 25 years, 12% after 30 years, and 13% after 34 years. Arguably, these are questionable real returns to expect in any environment, and even more questionable in the context of today's above-average valuations. So, how should we think about Social Security? Not merely as income to supplement your savings, but potentially we can think of it as longevity insurance, the risk that you live a long time. For those with sufficient savings, delaying is like buying a higher yield, inflation-adjusted annuity backed by the U.S. government. In other words, if your biggest worry in retirement is living too long, delaying benefits could be one of your best long-term decisions. Kit just emphasizes in this final chart that even with a trust fund shortfall, the delay still shows compelling returns because the benefit stream hedges market risk and inflation. This orange line in this chart shows the assumption that benefits receive a 30% haircut in the year 2034. If, on the other hand, your savings are thin, your health is uncertain, or you just need income now, early claiming may still make sense, but it should be a conscious trade-off and not a panic. In short, headline panic about Social Security doesn't justify automatic early claiming. Claiming early may feel safe in the moment, but in many cases, it permanently reduces your financial power. If you're in a position where you can delay and your plan allows for the temporary gap, delaying benefits can act like high-quality longevity insurance. Or you can view it like a solid investment with superior risk-adjusted returns compared to the alternatives if you live a long time. If you'd like to explore what your version of this could look like, click the link below to schedule a retirement readiness call.